The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Papa Jensen rides to the rescue. Now, it's Kevin Warsh's turn to do the same. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Emily Grafeo. We're kicking you off to the closing bell here in the U.S. in New York on a day when the S&P 500 is higher by about 0.5%. Of course, lifted from that outlook from Nvidia. The stock reporting earnings yesterday up about 8% right now. The focus now goes to Jackson Hole. We already had two Fed presidents saying that they want the Fed to act sooner as inflation remains above the central bank's 2% target. So that's pushing up yields across the curve, highlighting the two-year yield here just about at 4.2%. Oil also higher on the day, up about 2.4%, Romaine.
But we go back to that rally in Nvidia, which is a little bit less about the quarter that just passed and a little bit more about the longer-term guidance. 70% revenue growth all the way out to 2028? How about that? Putting a growth rate on a fiscal year that doesn't even start for another year and a half, a bullish signal that the fulcrum for this AI trade sees no let up in demand anytime soon. But here's the wrinkle. Jensen Huang also made it clear that he doesn't actually see any let up in the supply constraints that for right now are giving him and other component makers massive pricing power. Nvidia's already raised prices. Amazon, Apple, Qualcomm, to name a few. They've also let folks know that price hikes are coming their way, too. And that's raising questions about inflation fatigue that could upend both corporate and consumer spending. So maybe that's why on a day where Nvidia heads for its biggest post-earnings day gain in about 9 quarters, the vast majority of the rest of the equity market, that's underwater.
So you have a market on the S&P that at the top of the house is going to be much more influenced by the actions of the bond market than they had been in the past, simply just because of the issuance that we've seen. And I can tell you that right now there is this pretty big cognitive dissonance in the market between equity vol and bond vol that does not typically stay that way. You're going to see some sort of reconciliation.
And that is the setup for Kevin Warsh, who on Friday will deliver his first speech from the Fed's Jackson Hole Symposium since taking over as Fed chair. Torsten Slok over at Apollo saying Warsh likely to deliver an economic outlook with a, quote, hawkish flavor, a bid to keep long-term yields in check. But of course, his success in doing so might be a bit beyond his control. We've been talking a lot about this idea of some of the structural factors that have actually been pushing rates higher. The so-called debasement trade that some folks, if not embracing, certainly sniffing around at. And it raises a lot of questions about what that all means for all of the assets across the spectrum over the next few months. Stephanie Gill joins us right now, CIO over at Robinhood Markets. Kick us off to the close. Great to see you.
You too.
When you look at an earnings report that we got out of Nvidia, which seems to suggest the AI trade will go on, but you have to stack that up with all the other factors going on out there. Is there a case to be made for that AI trade, or should we be paying a little bit more attention to the Fed and rates and all of the macroeconomic factors surrounding us?
I think it's all intertwined because I think Nvidia is turning into a bank if you look at like the details of their financings. And you saw, their free cash, yes, I think the thing that moved them was the huge increase in 2028 sales growth expectations. But if you look at their free cash flow, it's half of what was expected. And then you add in stock-based compensation from that, or take it away, I should say. And they're doing buybacks, yes, but I just think if you don't have them as backstopping things, then there will be a dissipation. The one place that this is showing up obviously everywhere and starting to really be consistent is in the commodities market. Because if that demand starts to die down there, then I think that's a sign that it's dying down everywhere, since it feeds, like copper feeds into this stuff. But I think that it matters because if you think about the issuance of U.S. corporate versus treasuries. So treasuries have been consistently like around an additional $2 trillion a year. If you look at U.S. corporate, this year for the first time in like at least a decade, it's a net new issuance of $3 trillion. So it's more than the U.S. Treasury. So there's a competition to take down debt.
Yeah, it's real. I remember we had someone on this program earlier in the year who actually said they were taking more cues from the corporate credit market than they were with some of the Treasury auctions. And I kind of laughed. I mean, this was pretty prescient at the time, but now it seems very obvious. But it gets to this idea of what you think investors should pay attention to. I understand that the corporate credit issuance is driving yields to a certain extent, but obviously the AI trade is inflationary. We know that. It's having upward pressure, and that does not appear to be abating. I mean, we just heard from Best Buy earlier today, and they said, look, they're already seeing a slowdown in computer sales, which is kind of weird heading into the school year and the holiday season.
Because, I mean, if you think about it, like, I mean, there's a couple things I've bought recently that I've been, like, kind of shocked by the price.
Yeah, join the club.
But I think there's the consumer, you can even see it in the earnings, like some of them are doing really well. I think people just have limited income and they're just picking their spots in terms of the brands that they use. You saw that with Abercrombie and Fitch versus Dick's Sporting Goods, right? So I think the consumer definitely needs to try to hang on, but I don't know if that's going to be the driving force of the market because the market is so dominated by this AI theme, and I just don't know if that's going away. But I do think free cash flow is going to matter in an environment where interest rates are unlikely, I think, to fall anytime soon.
You know, we've been talking about the debasement trade a lot and what it means for where investors really should be positioning against the risk that the dollar no longer becomes a reliable store of value. What are your thoughts on that?
I just wrote a piece, The Value of Store of Values for Investors Guild is my weekly blog. I was actually talking about this and I said, like, the store of value is the first thing to go usually, and then the other things like the transactional aspect of money takes longer. I do think gold is something that everyone should be considering as a store of value. We've, in Robinhood Strategies, added to gold in the last week or two. We also have materials names in our portfolios to also be a part of this. I think you want it, like commodities is definitely a place that I think will continue to move higher, and that can be a protective point. Bitcoin is a place that I'm not quite sure yet about. I think it could potentially be, and I definitely think for the financial system it will start being more prominent, but I'm watching the technicals of that, and I'm like, is the recent pop a fugazi or not?
Right, yeah. I mean, there's going to be a lot of focus, I think, on where long-term rates go from here, particularly with Jackson Hole. Do you think that there's a level that entices more buyers to come in? I think Guggenheim was saying earlier this week, like 6% was the level that, they would come in and be a buyer. How is that dynamic kind of playing out right now?
I definitely think there'll be a level. What is it? The level of resistance seems to be 4.7 on the 10-year, 5.3 in the 30-year. Yeah, if you saw 5.25, 5.3 on the 10-year, you might start to see it. I also think back to when that term bond vigilantes, which was quite prominent in the kind of 80s, and that was when the last time that we actually had interest costs as a percentage of GDP for the U.S. for Treasury market be over 3%, and now it's back to being over 3%. So I think the bond vigilantes might actually help keep a lid on it and force the issue, like you had the Wall Street Journal op-ed from Druckenmiller. So I think that if you do see pops, that will actually all of the rhetoric will start to get people to pay attention to it, and that may be a stepping in point. But I still don't like being long duration personally.
Well, no one seems to like being long duration these days, but whether it's in the fixed income market or equities as well. But it's kind of interesting, like on a day like today, where Nvidia surprises, and then you see how concentrated the rally is. I put that in quotation marks because it's basically, if it weren't for Nvidia, we'd be in the red. But every other company that's higher basically has a direct link to Nvidia in some way or another, and then everything else is either flat or down significantly. And I do wonder if we start to see a return to that concentration in the equity market if AI is the only story until we get something else.
I think the only place that you could, the opposite to that is in the healthcare space. I do actually think it benefits from AI discoveries and linking things. Someone put it this way to me, which I really appreciated, which is you have specialists, just like doctors can be specialists, and sometimes it's frustrating for you because you want somebody to think outside the box for you. LLMs can help you connect things that specialists are not looking at together, and I think that's what happens in healthcare. So we are making sure we have allocations there as well, which isn't necessarily directly tied to the AI trade.
Yeah, and there's no direct link. We're actually going to talk to the Agilent CEO a little bit later. The picks and shovels of the life sciences business right now. Stephanie, always great to have you. Stephanie Guild, CIO over at Robinhood Markets, kicking us off to the close here on this Thursday afternoon. A focus on the AI trade and a focus on computer storage and Everpure. It used to be called Pure Storage, and well, now it thinks it can be everywhere. A beat and raise quarter. We're going to catch up with the chairman and CEO to talk about where the next opportunity lies.
Plus, from one earnings report to another, life sciences firm Agilent benefiting from improving end markets. There you go. And stronger demand in its latest quarter. Like Romain said, we're going to sit down with the CEO exclusively on the heels of the results to hear more about what's driving the business.
And another exclusive conversation. Emily, how much do you think a law firm can be worth? Well, John Morgan, well, he's got a pretty high price tag. And, well, if you want to find out, stick around. We're going to catch up with him later in the show as well, right here on Bloomberg. Welcome back. Shares of computer storage company Everpure down on the day, despite the company beating estimates and raising its full year forecast as it gets a boost from the hyperscalers. Joining us right now is the chairman and CEO of Everpure, Charlie Giancarlo. Hey, great to have you here, Charlie. Let's first start off talking about, it was a good quarter, 38% jump in revenue. You raised the full year sales guidance up to around, I think, $600 million above that midpoint here. It gets to a lot of questions, though, as to sort of what were the expectations coming into this quarter, and what do you think you can do to satisfy investors going forward? Is this a growth story with regards to new customers? Is this a growth story with regards to higher prices? Where does the growth come from?
Well, the answer is both. I mean, higher prices, of course, has driven the top line, but frankly, it's our market share pickups that are driving the top line even more. I mean, our core business, the core sales of product were up 50%. Our sales of our as-a-service product offering were up 120% year over year. You put those together, I mean, our growth rate is just incredible right now. And, no one can really explain on the day-to-day, but we're up about over 50% year over year in terms of our stock price. Just in the last quarter, we're up at least 30%. So, we've seen a lot of stock price improvement. So trading on a daily basis is a fool's guess.
Yeah, absolutely. But with regards to the longer-term story and the longer-term agreements and the hyperscaler deals that you're adding, can you give us a sense here as to whether those deals are binding or at least have some sort of minimum purchase commitment in them that would be binding, that would make investors comfortable with regards to meeting longer-term targets?
Oh, yeah. I mean, these are not, when you put together agreements with hyperscalers, you're not doing it on a weekly, monthly, quarterly basis. You're putting together annual agreements that are commitments on both sides for a period of time. And, we have visibility out to 2028 in terms of what sales of our solution are going to be in those hyperscale environments. So they are based on contracts, so they're solid as far as we're concerned. Now, because we currently have 2 hyperscalers signed up, and because we are being very cautious with their what they consider their intellectual property, the amount of those sales, we're not very explicit in that, but we are talking about tens of exabytes of product that will go into their infrastructure over the next couple of years.
Talk a little bit more about the visibility that you have into just how the AI infrastructure landscape has been evolving as we continue into this kind of build-out cycle.
Right. Well, I mean, our solution into the hyperscalers serves multiple purposes. They don't build storage specifically for AI or for other uses. They use their general purpose storage in all those environments, and we're going into their general purpose storage. But AI, without a doubt, has affected the market in incredible ways, and you were speaking about it just a bit earlier, where the demand has completely outstripped supply in the semiconductor market, and that's driven prices to just levels we haven't seen in 10 years. So it's affecting the market in many ways. I would say that customers continue to buy, so that that we've seen that in our top line. But frankly, we're picking up market share at our core market as well, and that's really what's important to us, is seeing that we're not only doing well because of the general uplift of the market, but we're doing extraordinarily well because our competitive stance is just so much better than it was even a few years ago because of the investments that we've made in our business.
Speaking of that growth and that market share, you were mentioning how much the stock price has grown. You're actually now one of the largest companies in the S&P 400, one of the largest eligible to move up into the S&P 500 when they announce their index changes in just a few weeks. What would it mean for the company to get added to the S&P 500?
It'd be a source of pride, I think, for the company. Of course, it brings on new responsibilities. Frankly, our ambition is to be the largest vendor in not just data storage, but data storage and management with our customers. That's a huge opportunity ahead of us. We just guided to a $5 billion year. That opportunity is 10 billion plus, in terms of total opportunity, and getting into the Standard & Poor's 500. Is the next step on the ladder, if you will, but lots of steps beyond that. So, we have very high ambition, and frankly, we have the track record of beating and raising for the last 8 quarters, consistent beats and raise, and we expect to continue to do that.
Is there any sense here, though? I am curious about, we talk about just how much AI is assisting, or you and your team talk about this, but it's not actually broken out in any way. Is the AI business as a standalone going to become a big enough business where you would feel comfortable breaking it out as a line item on the income statement?
Well, to be honest with you, we have a lot of things vying for a very large portion of our business. The hyperscale business is going to be a very large portion of our business, certainly from an operating margin standpoint. Our core business, continues to grow, and it's, as I mentioned, we're growing at well over 50%. In that business right now. And then we have the AI portion of the business, which arguably is still relatively small in the enterprise environment. We do see that growing substantially. I think, it's hard to predict exactly what will be broken out over time, but we have a lot of growth areas that are vying for, the next big movement, if you will, in our total growth.
Only about 30 seconds left, but I remember when you kind of came in, and you had this big all hands on deck back in 2017 or whatever it was, and there was when you were called Pure Storage at the time, and there was a lot of talk about whether you would keep that name, and you said, yeah, we'll keep it until we don't need to keep it. You changed the name 9 years later to Everpure. What does Everpure signify? That Pure Storage
signifies two things. Yeah, first of all, that we've now grown beyond just storage. Now, storage is still very important to us, to be clear. But now we are going after the data management portion of the business, enabling customers to make better use of their data by cataloging it, classifying it, creating context around it, and then allowing customers to understand what's the sources of truth from within their own data environment. We're going to get to a point that we call data primacy, which we've written a document on now, where applications are designed around data rather than data being designed around applications. So that required us to move away from just being known as a storage company and moving into the data management portion of it. Mm-hmm. But we wanted to stay pure. We wanted to stay true to our core principles, stay close to our customers, stay close to our R&D and our technology and innovation roots, and therefore Everpure.
All right, Charlie, we'll catch up again soon. Charlie Giancarlo, the chairman CEO over at Everpure. When we come back, we're going to talk Nvidia. Stick with us. This is The Close on Bloomberg. Shares of Nvidia surging on the day. This after the company posted a long-term growth forecast that, caught everybody by surprise. Our next guest, though, says scarcity is the only reality right now in the AI build-out as these giants look to speed up in this race. Antoine Chkaiban joins us right now, equity research analyst covering technology infrastructure over at New Street Research. And Antoine, I do want to start there with the scarcity idea. One number that popped out at me in that Nvidia report wasn't the revenue and earnings, but it was the supply commitments, which more than doubled in the quarter. And Jensen Huang was very blunt about it. Basically, they're trying to get their hands on as many of the components as they need right now to take advantage of this. They get hit by that supply constraint, but of course, they're also benefiting from that supply constraint as well. What's the balance for them?
Yes, thanks, Romain. Happy to be back on the show. I would say, when you look at the pace at which Nvidia has been growing, and like the 70% guide for next year, it is supply constrained. So it's very important for the company, to ensure that they have, one, sufficient supply to meet the guide, and two, that they can get, their hands, for example, on these very expensive memory chips at a price that allows them to also defend, the 72 to 73% gross margin that's holding up well as well. So I think securing supply is at the same time an opportunity for them to make sure that they can address the demand and make sure they can address it with good margins given the bit of materials of these GPUs that keeps increasing.
Any sign then that demand would at all fall off, or is the takeaway in your view from this earnings that we don't really need to be thinking about demand at least for quite some time?
I think what the print gave us yesterday is just extremely good visibility on the near term. Mm-hmm. So we know that Nvidia is sold out until the end of 2027, basically, and we already kind of knew it. When Jensen guided the $1 trillion worth of orders back in March at GTC. Now we see it in revenues, in the guidance. Now the question, is what happens beyond 27? And of course, if they're supply constrained and by the way, I'm talking calendar on 27, if they're supply constrained in calendar 27, it's probably going to extend the cycle into 28. And we hear that, by the way, across the board from other vendors, across chips, equipment, networking, etc. We hear already visibility into subsequent years, and we hear it from semicaps, by the way. When semicaps tell you they have visibility. Like the guys who actually sell the tools to make these chips, they tell you they have visibility that extends, for a few years. That's actually the strongest data point that tells you, that if we're adding more capacity to build these chips, that we're going to keep growing, probably until the end of the decade.
Well, talk to us about competition to Nvidia, because that could look a lot different by the time we get to 2028 than what it looks like today in 2026.
Yes, that's definitely, of course, like a major concern. We've been following, by the way, like a big event, Hot Chips, where you have all the hyperscalers who came on stage and announced, for example, Meta came up and gave a lot of details about their MTIA accelerator. Google gave details about their TPU. We even had, OpenAI come on stage and show you that in 9 months, they were able to pull together a chip and actually a system that is, quite competitive with Vera Rubin. Yeah. All right, Antoine, got to leave it there. Great stuff. Antoine Chkaiban, equity research analyst over at New Street Research. Nvidia shares up about 8% here on the day. Another stock that is on the move today, Agilent. A big earnings beat. We're going to catch up with the CEO, Padraig McDonnell, for an exclusive conversation about what's next for the life sciences company. That's coming up next here, right on the close, right on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic.
And I'm Malik.
We've been talking a lot about Nvidia, which of course is kind of the quintessential picks and shovels company in the AI space. But there's another company out there, Agilent. It's kind of the picks and shovels company in the life sciences space, which actually has a lot of similar parallels to what's going on in AI directly.
Yeah, there's a lot of crossover, and you can see the stock up in the green right now, Romain.
Yeah, it's up about 1% on the day. We should point out this stock's been on a tear since its last earnings report 3 months ago. I think it's up roughly about 40% since late May here. So some people now are trying to get back on board with this stock, and a lot of that will depend on, well, how much they can keep this growth going. Padraig McDonnell joins us right now. He's the CEO of Agilent Technologies, coming off of revenue growth in the most recent quarter of about 7% on an organic basis, adjusted EPS of $1.62. There is a durable story here, Padraig, but walk me through the mechanics of what led to the organic growth, what led to that EPS number this quarter, and whether that's sustainable for the next quarters coming up.
Yeah, thanks very much. So Agilent is a part of an essential infrastructure behind modern science, from developing and manufacturing new medicines and diagnosing cancer to ensure food and water safety, and actually enabling advanced semiconductor manufacturing, which is really critical at the moment. Thinking about the quarter, we delivered 7% core growth. We saw strength across all three businesses while significantly expanding our underlying margins. And what is most encouraging is the performance was broad-based, both with improving markets and a compounding effect of our in-house Ignite transformation initiative. We're building a company that's really sustainable to outperform the markets over time.
Well, I mean, we've seen that too. I mean, we should point out, I mean, it's like a third of your revenue actually comes from the instruments themselves, and the rest of that is from sort of repeatable revenue with regard to the consumption and services tied to that. How durable is that model, Padraig?
Yeah, it's very durable. Coming out of the strong quarter, what's coming together for is the benefit of two instrument replacement cycles and two reshoring waves, both on the semiconductor and the pharma reshoring in the US. So we're all set to crest at different times over the next 2 to 3 years. And we have a differentiated CDMO capacity that's poised to go online over the next years. And I think that's all against the backdrop of improving end markets and structurally better execution. And what I'm really excited about is finishing the year strong, and I'm really optimistic about 27 and what it holds both for us and the life science industries. And the life science markets are improving. You see that across the board, whether it's pharma, chemical and applied materials, or diagnostics. And it's got steadily better through the year, which is great.
So you've been a player in life sciences consolidation over the years. What would be attractive for a potential deal? Would it be, wanting to expand into a new region or a new business entirely?
Yeah, so we're in amazing markets, but there's a lot of fast-growing adjacencies, so continuing to add to our service capability. Also, you look at the area of AI and software and the idea of autonomous labs. These are labs that are going to be autonomous over time. So looking in that space, how do we, partner, invest in physical AI, but also in our tools to make sure we have the right tools for the future. And you see that also in our semiconductor business, where we have reshoring going on, and no fab runs without an Agilent machine or an Agilent technology, both on the high purity chemical side and on the nodes. So we have a lot of growth vectors going forward and a lot of areas where we can expand.
How healthy do you think the supply chain is in the semiconductor space? I know it's a little different than, the Nvidia chips, but of course we were talking earlier about Nvidia's supply, and this is a company that's talking about not being able to procure the supply that they need. What does it look like from your business?
Yeah, so talking from our perspective, we're the beneficiary of AI by plugging into chip manufacturing. So you see us in fabs, you see us in the support infrastructure around fabs. No fab can run without our system, so we're incredibly important to the semiconductor supply chain, ICP triple quad technology. And also, you might have heard of Forever Chemicals. That's another area that needs to be tested in these fabs, and we're the world leader in those tests going forward. So from our perspective, we're really at the forefront of all that.
You talk a lot about the reshoring here in the U.S. being a benefit to your business. There was still some meaningful growth in China, 9%. That was against, I think, guidance that you guys had given basically for the quarter to be flat. What's driving that? Is that also something that could be a meaningful contribution going forward, China?
Yeah, so China is an upside driver for sure. Strength is continuing. It's a hotbed of innovation in life sciences, and we have a long-standing presence in the region of over 40 years. And what you see in that, you see in the region, a lot of innovation, a lot of manufacturing companies from outside China investing in R&D in China, but also a big indigenous pharma industry, which is really important. But also think about semiconductor in China. That's an area of exposure we have, and we're servicing that area as well. What we've seen in the quarter as well is an uptake in testing laboratories for food and environmental. That's been a core of our business, testing for PFAS and contaminants, both for food export and for local use. So again, it was a very great story, a big step up for China, and we've been making investments over the last number of years to make sure we can continue to grow.
The only declining market that I saw in your statement was all in that academic and government revenue, down about 3%. And it's raising a lot of questions, particularly given some of the changes with regards to how the U.S. funds academic and government research. Is this a business that you have any intention of putting a little bit more attention to, or are you just going to accept the fact that the times have changed and maybe the funding has shifted elsewhere?
Yeah, look, it's a market for us, but it's a relatively small market. I think if you look at the U.S. market, it's probably 2 to 3% of the whole company, and it's been challenged. But we're ready with our tools, and it's important that our tools and consumables and services keep these labs up and running. We're hoping next year we see an inflection in some of the projects going through, but it's an area we're going to keep focused on because it's incredibly important for the speed of science, and also that we stay connected very closely with this market with new innovations.
How is the partnership going with OpenAI? Tell us a little bit more about that.
Yeah, so with AI, we take AI with one simple thing in mind: growth. Is how can we improve business for our customers and make them more efficient? So we worked a partnership with OpenAI. We're looking at how we create abundance within the company, about how we do business faster with customers. But in our products, the idea of physical AI and the ability of our software to be leading the way in this autonomous lab. And that's going to be really clear over the next couple of years. If you think about the autonomous lab where OpenAI would be really important for us on the software side with coding, etc., our tools are the eyes, automation or physical AI are the hands, and the agents running the experiments are the brain. So you can see AI across all that value chain. So the future is very bright, and we're very well positioned for that. And I have to say, if you lead with growth and think about how you're going to create more growth for your customers, it's proving that it's going to be very successful for us.
Well, but as you start embedding a lot of this AI and automation stuff into these kind of workflows, when does that become a separate line item that folks can look at, rather than just me going to the slide deck and seeing whatever management decided to call it?
Yeah, the great news is that it's really early stages. The market is actually being created, and we're at the forefront of that creation. So it's really early to see it. What the good news is that we're involved with a number of lighthouse companies about how we're partnering and how we can make that more effective for our customers. So you'll see over the next year more information coming out for us. And over time, I think you see the future will be much bigger in that regard. And why is it important for Agilent? Because we help the customers be more productive with it, but also we actually create more value streams around that, not just the tools or the services, but more software and AI interaction for the customers.
Padraig, before we let you go, I just kind of have to point out, too, you've been with this company for decades and obviously worked your way up to the top. You came in here with that Ignite transformation, a way to sort of make sure that this company was set up for the future. As it stands right now, and since you've taken over as CEO, can you tell investors right now that has actually been mission accomplished, or is there still more work to do?
There's still more work to do, but what I say, the first 2 years of the foundation we put in has been phenomenal. You look at our margin, you were dropping more to the bottom line than what you're seeing on the revenue, which is really strong. We have a lot of more enterprise capability around enterprise pricing. Now we're turning our guns on internal innovation through Ignite, but also through AI is being run through Ignite. So building that foundation was really important. We're far more nimble, we're executing faster, and it's going to help every facet of the company, how we can bring more technology to our customers.
All right, Padraig. Well, we'll talk again soon. Padraig McDonnell, he is the CEO over at Agilent Technologies. The share is up for a third straight day on the back of that company's earnings report last night. When we come back, we're going to take a look at shares at Wendy's, not doing well at all, down about 13% on a report that Trian maybe has no plans to take it private. That's our stock of the hour. It's coming up next, right here on The Close, right here on Bloomberg. Shares at Wendy's having their biggest one-day drop since 2020. This on the back of a report that Trian Fund Management has no plans to take the burger chain private. Daniela Sirtori joins us right now, who covers the restaurants for us at Bloomberg from our Chicago bureau. It just seemed, like a couple weeks ago, the stock was having its best day ever on the reports that they might actually be taken private. So what do we know, Daniela?
So what we know is that, there's been this back and forth of whether the company may or may not be taken private. It's interesting in the sense that, of course, there was an idea that perhaps an investor, taking the company private would accelerate changes, but it's worth noting that Wendy's is already implementing a lot of changes. The company knows that it has fallen behind. Its same-store sales have declined for 6 straight quarters or something like that. And they have a recently appointed CEO who has made new management changes. They have a new marketing chief. They have a new CFO. So changes are already well underway at the company.
But can it really turn this around without that bid to take private? Clearly the investors today not too confident about that turnaround plan.
It might be a question of how long is this going to take, because just to give you a little bit of context, the new CEO outlined some pretty fundamental issues that the company has faced, right? So he said that the company has let quality slip, that they've relied too much on deals, that their marketing hasn't hit. So he seems to be that there's just a lot of changes that need doing. And of course, when you're a public company, it's just harder sometimes to go fast enough when it comes to those changes. But, it's not like the company was stagnant and they needed a jolt from an outside investor. Well, not an outside investor, so they're already in the company. But, there was already a plan that was in place, including a new CEO, right? The company has had about 3 CEOs in the past few years.
Well, I guess the idea, you kind of talk about this idea. I always thought that they were one of the better performing of the fast food chains, not just in terms of actual sales, but just in terms of perception, brand equity, et cetera. Has that been lost to a McDonald's or Burger King or whoever?
That has definitely changed. So if we remember, like a few years ago, Burger King was actually the one that slipped, and Wendy's became the #2 burger chain in the U.S. And that has now, as of this past quarter, changed. Burger King is back on top, and it is interesting that the CEO, I think, was pretty candid in the most recent earnings call, and he said, yes, like we had this perception as being a high quality, and that has just slipped. It seems like they said they were cutting corners to save money.
All right, Danielle, I got to leave it there. Daniela Sirtori there. A closer look at Wendy's. The shares down on the day. A little bit of a back and forth as people try to figure out, we'll try and actually do something or maybe not. When we come back, we're going to count you down to those closing bells. Saira Malik, CIO over at Nuveen. She joins us next. This is Bloomberg. Just about 10 minutes until we get to the closing bells here on this Thursday afternoon. Emily, stocks in aggregate are in the green, but it's a pretty narrow rally that we're looking at here.
Yeah, Nvidia is really the focus right now. It's up almost 9% after raising their outlook after earnings last night. And you can see at the index level, not as much movement there. Like you said, Romain, the S&P 500 only up 0.6%. Still in the green, though. Oil higher as well. And yields moving up higher, not by too much, but it's across the curve. The 2-year yield up about 2 basis points, longer end yields up as well. We did have 2 Fed speakers already at Jackson Hole talking about how inflation is still above that 2% target, and they want to see the central bank act to control it.
Yeah, and we're going to have a special coverage right here on Bloomberg tomorrow morning from Jackson Hole with Tom Keene, Michael McKee, a few other folks that I'm probably forgetting will also be out there. And of course, we are going to hear from Kevin Warsh with his keynote address at 10 a.m. Eastern time. So you definitely want to tune in for that, as the market in what should be normally a relatively slow August has really had a lot to chew on over the last few days. Saira Malik joins us right now, CIO over at Nuveen, to help us break down maybe what investors are going to have their eye on. You talk a lot about this idea of some of the pressure points out there with regards to some of those long-term Treasury yields, the AI earnings, and the need to sort of prove itself, rising oil prices. We see where oil prices are. I guess we got some proof of life yesterday from Nvidia on AI. Still, though, the jury is out on where Treasury yields go next. What do you expect tomorrow?
What we expect is interesting. The markets are not pricing in a big move tomorrow, given Warsh's speech. It's about 60 basis points in terms of plus or minus. So it's not a lot of expectations out of it. What I'll be looking for is, does he have commentary around his comfort with long-term yields at over 5%? And also, how is he thinking about inflation and the strength of the economy? Just recently, jobless claims have been at the low end of the range. PMI data has been very strong. The Philly Fed data has been at some of the highest levels in years. All of that is telling us the economy is strong. Inflation is here to stay. Yields are telling us that. It'll be interesting to see if we get any commentary from Warsh around any of those items.
It gets to this idea, though, too, when we talk about equity traders and how they're valuing stocks either on an individual basis or in aggregate. How much of a factor do you think current yield levels will be, and bets on what the direction is for those yields?
Yields are increasingly important. It used to be more about the bond market and how is the bond market thinking about them, but equities take note of what is the 10-year and what are 30-year yields doing. And we've been seeing those creep upward, mostly because for one good reason, which is a stronger economy, but one reason that's not so great, which is that inflation is structural. And how will the Fed react to that? Will they raise rates, or will they be able to stay on pause? I don't think we have any cuts on the table, but what to watch there will be the employment markets, which have weakened. Now, of course, if employment markets continue to weaken and inflation stays structurally high, then we have to start thinking about stagflation. I'm not thinking that stagflation is going to be an issue yet, but that's another thing to watch. Employment markets, are they going to keep getting worse? And secondarily, will inflation stay structurally above target, which is where we are on inflation already.
So where in the equity market then is basically a good place for investors to hide out? Is it the mega cap tech stocks that have these strong balance sheets, that have this resilience, or is it maybe some more unloved parts of the equity market that haven't rallied yet?
But there's been 3 pressure points causing turmoil for the markets recently. That is yields, which we already discussed, higher oil prices, and of course, questions around the AI trade. Nvidia answered that question yesterday very boldly and dismantled the bears' case on AI. People had been worried about AI spending. They talked about spending on CapEx through 2028. And even more importantly, they raised revenue growth for fiscal 2027 to 70% when consensus was at about 45%. So that's very bullish for tech stocks. And we're seeing that today at the expense of everything else that's not technology. We're also seeing software recover. We'll see Workday report after the close today to see if that continues. But if software and hardware and semis are continuing to show the strong earnings numbers, I think tech will continue to lead from here, and that'll be what takes markets higher.
Hey, what about within credit markets? We had a guest on The Real Yield a little bit earlier today saying that the equity investors have fared well from AI, but the fixed income investors haven't. I think he said we've been a bust. AI has been a bust for fixed income investors. Is there opportunity now to come in where spreads are?
Well, spreads have been pretty tight recently, which has been a little bit challenging for fixed income markets. But of course, yields are high. So returns on fixed income are you can still get pretty strong returns on fixed income. It's interesting, you are seeing AI creep into the credit markets, though, in terms of the types of credits that are available for fixed income investors. But the main beneficiary of the AI trade is the Mag 7 and the NASDAQ. That's where the earnings is. And that's why those are the companies that have been leading the markets higher on the equity side.
I do. It's kind of interesting. We talk about the Mag 7, but were you surprised at some of the results that we got out of some of the software makers? I know all the focus is on Nvidia today, but I mean, you have Salesforce up 20%. A lot of the other software makers that have reported over the last couple of weeks seem to have sort of at least for now, put some of those fears about that SaaS apocalypse to rest. And as you said, we're going to hear from Workday and Autodesk after the bell tonight. Is it too soon to sort of make a call on that?
Well, there was so much noise around the impact of AI on software companies earlier this year, but really when you separate the signal from the noise, it didn't show up in software companies' fundamentals. Revenue growth rates for software companies remained fairly stable. Earnings have remained very strong, and so have margins. So we're not seeing it. I think it was just a lot of concern earlier this year. There was so much talk about how many jobs is AI going to eliminate. We're not really seeing that to a great degree at this point. And which sectors is AI going to replace? People were very concerned about software. I don't think that's the case. So I think you will continue to see these companies rebound from the ashes.
Just real quickly, we're also going to get Marvell after the bell tonight. I am curious, anything to read from Nvidia's earnings into Marvell? I know not quite apples to apples, but there's got to be a connection.
My question will be, if Marvell earnings are strong, it'll tell us that the AI trade is more than Nvidia. It's broader than Nvidia. I would like to see that with strong Marvell earnings.
Saira, always a pleasure. Saira Malik, CIO over at Nuveen, counting us down to those closing bells. Emily, we are just about 3 minutes away from those bells. And a reminder, we are also going to get more earnings. Earnings season never stops. You heard Saira refer to it. We're going to hear from Workday. We're going to hear from Autodesk. We're going to hear from Marvell. We're also going to hear from a couple interesting names in the more consumer-facing sector, Ulta Beauty, Affirm, as well as Gap.
Yeah, I mean, I think it's a good tailwind for these retailers, considering what happened with Abercrombie yesterday. But the software names have really been surprising. Salesforce up 23% right now. So the SaaS apocalypse is behind us, I guess? It's over?
Yeah, well, it depends. I mean, not all software companies are alike. Some have a little bit more of a moat. At least that's what Mark Benioff will tell you. Others maybe not, and maybe we'll find that out in the next few minutes. Those closing bells are upon us, with most of the major indices right now holding in the green. A full breakdown of all of today's price action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Emily Grafeo, taking you through to that closing bell. It's a global simulcast. Tim Stenovic joins us from the radio booth. Lisa Mateo in today for Carol Masser. Welcome to our audiences across all of our Bloomberg platforms, television, radio, our partnership with YouTube. And, of course, to parse the most crucial question of the day, Lisa Mateo, who's worse to work with, Tim Stenovic or Tom Keene?
You're going to put me on the spot with that one.
I like that.
Tom's probably watching and having a heart attack right now. Sorry.
We
Tim,
love them
you're
both.
Not bad.
Oh, thank you. Lisa's just going to say that until tomorrow. Then she can go back to work. You know, it's saying it's better to work with Tom because she's only with us until tomorrow. But it's been great so far. One thing that I am watching here, guys, and I don't want to kind of steal anything from Emily here, but I can't help but look at the concentration risk, or what some are referring to as concentration risk in today's trade. I mean, nearly every industry group is lower except for information technology. So this is really, even though we're seeing the index is higher today, it's really just about tech.
Yeah, the breadth is bad in this market. And you can see that not only in the composition of the S&P 500, but also in the Russell 2000 underperforming, and the NASDAQ 100 really leading the way here.
Yeah, and I'm keeping an eye on yields. With sticky inflation, you have to look at yields are higher. The 2-year 4.229, up about 2 basis points. We have the 10-year at 4.67, and that's up about 2 basis points as well.
Yeah, the coin called BIT holding out right around that 80,000 mark. You are seeing oil slightly higher on the day, and you talk about that concentration risk. I know we're going to talk a little bit more about that in a second, but this is basically the Nvidia rally. The majority of the point gains in the S&P 500 directly attributable to that name. But, you know, sometimes you take a gain where you can get it. Up 50 points on the day for the S&P, right around that 7730 mark, up about 0.7%. The Dow adding about 100 points, or 0.2%. The NASDAQ composite up about 1.6% to close out the day, while the NASDAQ 100 adding 1.4, and the Russell 2000 getting in on the action with a gain of about 8 points, or 0.3%.
Yeah, just to illustrate that lack of breadth that's happening in the S&P 500 right now, things are still getting settled. But even though the S&P was up more than 0.7%, Emily, only 150 stocks moved higher today. 350 moved lower. And
speaking of illustrating, if we go to the IMAP, you can really get a good visual of the concentration. The only sector in the S&P 500 that was in the green today was information technology, up 3.4%. Every other sector in the red, leading the losses here: consumer staples, healthcare, and consumer discretionary. But even energy, which is kind of a picks and shovel AI trade, was not able to post a gain today.
All right, I want to remind everybody we are still awaiting earnings. It's still about Nvidia in today's trade, but we're expecting to get Workday and Romaine. I think it's crossing right now.
Let's actually go to Autodesk first. Autodesk crossing the wire, the knee-jerk reaction for the software maker, down about 2% here. Adjusted EPS did rise to about $3.30 year over year from $2.62 the previous year. Net revenue in the quarter about in line with estimates at about $2.05 billion. The street was looking for $2.01. Billings in the quarter also slightly above estimates at about $1.85 billion. The street overall was looking for $1.81. Here's your forecast, Tim. Autodesk saying that revenue for the current quarter will be in a range of $2.13 to $2.14 billion. The street was looking for $2.08.
Okay, that's Autodesk. I'm looking at what's going on with Workday right now. A lot of eyes on this company after what happened today and yesterday with shares of Salesforce. Workday second quarter revenue does meet estimates. Shares in the after hours up 0.2%. The company sees fiscal year subscription revenue coming between $9.94 billion to $9.95 billion. The estimate was for $9.95 billion. So pretty much in line there. The company sees fiscal year adjusted operating margin at 31%. It saw about 30.5%, and the estimate was for 30.5%. Second quarter revenue coming in above estimates ever so slightly at $2.65 billion. And the company sees third quarter subscription revenue at $2.52 billion. Shares of Workday down about 1.2%. Remember, there was that interest, or reported interest, earlier this year from Silver Lake that caused shares to move higher.
Absolutely here. And of course, not all software companies are treated equal. We talk about the big gainers on the day, Tim and Lisa, and one of them was a software name. And I think where a lot of folks are wondering whether we can take sort of what was out of Salesforce and maybe extrapolate into what we would hear from Workday and Autodesk. But obviously, every software company has a little bit of a different take here on how they fit into the AI story.
Yeah, we had a great conversation with Brody about this earlier. I mean, we were told there was going to be a SaaSpocalypse, right? And even though a gain like today we're seeing with Salesforce, with the stock up more, the most going back 6 years, it's still down around 5% on the year. So it speaks to the challenges that I think some investors in the public markets still have when it comes to the effect of these AI companies on some of these cloud providers. Or software providers.
Well, I get it. Yeah, and it's this idea, though, too. It's like, okay, well, if you're just sort of a generalist in this space, maybe AI does eat your lunch. If you're more entrenched, which is sort of the argument of Mark Benioff at Salesforce would make, that when you're more entrenched into some of these some of these big corporations and their enterprises, then maybe the AI story isn't as much of a threat. But as you said, the jury's still out. There's been a big rally in these names today and over the last 2 weeks, but all of these names are in the red.
It doesn't hurt to have Dario Amodei join you side by side to talk about a partnership between Anthropic.
Absolutely.
What some people say is like, okay, the company that is the biggest threat to these SaaS companies.
Yeah.
So, that doesn't hurt.
I trust me, when I have my annual review, I'm going to see if Dario can join me.
Maybe you might have to settle for Claude. Bad news.
For Claude, okay.
Yeah.
Well, who knows?
That's really the question, though, for these software companies. Like, can they stay resilient in the age of AI? Do they create their own AI product, or do they choose to partner with other companies? At least for Workday, the CFO saying in the results, our results reflect continued momentum across the platform. AI emerging as a strategic driver of customer expansion. Look, it's not much to lift the shares right now. The stock down about 4% now in the after hours.
Two questions also about what these companies are doing with cash. The company authorizing an additional $4 billion in share buybacks. That's Workday. Shares down in the after hours still by 4.3%. Once again, fiscal year adjusted operating margin. The company sees fiscal year adjusted operating margin coming in at 31%. That's an increase of what it saw earlier, which was 30.5%. Like you said, though, with that narrowing of its fiscal year subscription revenue forecast, not doing much for shares in the after hours.
All right, now let's move on to the chip space here and away from the software space for a second. Marvell's earnings crossing the wire right now. Second quarter revenue does beat slightly, $2.74 billion. The street was looking for $2.71 on average. Adjusted EPS, 94 cents a share. That's about a penny above the average of street estimates. Take a while here to dig in to try to find the forecast, but overall, the company is saying, at least on the surface, that it is expecting gross margins of roughly about 58%, which is around what the street was looking for here. So no real material up in that margin guidance.
Okay, this is Marvell Technology, shares down about 1.5% in the after hours. These earnings, they continue to come. Looking at shares of Ulta Beauty right now and looking at headlines, the company sees fiscal year earnings per share coming in at $28.70 to $29. It saw $28.36 to $28.80. The company sees fiscal year comp sales increasing 3.2% to 3.7%. That's an increase from what it earlier saw, which was 2.5% to 3.5%. Shares of Ulta Beauty in the after hours up about 2.8%. Looking backwards, the company's second quarter earnings per share coming in above estimates at $6.55, and second quarter comp sales coming in way above estimates at 3.8%. The estimate was for 2.44%. Ulta shares higher by about 2.8%.
And it raises a lot of questions about this idea of where consumer spending stands. I mean, you think about just how much of a mixed picture it's been out of a lot of these consumer-facing and retail companies. You have some companies reporting great growth, others still struggling. I thought it was interesting when we had last week, we were talking on the program about Walmart and the idea that, you know, a company that actually raised its guidance still got hit in the market, primarily because of that seemingly potentially slowdown in some of that sequential same-store sales growth.
Yeah, and you think about where the consumer is, it's really a mixed bag, Romain. Like you said, we just had Abercrombie earnings the other day, that stock blowing it out of the water. Ulta Beauty, another consumer-focused name. Look, the read right now, at least from the second quarter, is positive, a positive read on the consumer. We do still have to see that forecast, though.
But did you guys see the results we got this morning out of Dollar General and Dollar Tree, and this idea sort of like how you have two companies kind of in the same space, kind of moving in different directions for different reasons. And it gets to this idea, I mean, we're beyond K-shaped or whatever people are doing trying to describe this economy. I think we just have to kind of come up with a new letter or shape to sort of, characterize it better.
Well, the Treasury Secretary would like to see a C, right?
Yeah.
He calls it C-shaped.
The Treasury Secretary.
Yeah.
What's he up to these days? We haven't heard from him in a couple of days. Did you watch that press conference he gave earlier this week? It was Monday.
I cannot believe that was this week.
Yeah, it was
I'm looking forward to tomorrow.
Yeah.
How's that?
You think that's going to be better?
Yeah, it's happening before.
Lisa?
It's happening
Lisa,
before our
what
shows.
happened? Why are you here? Did they not invite you to Jackson Hole?
No, I did not get the invite.
Wow.
Maybe next time. Maybe next time. I know. I heard the Cowboy Bar is a fantastic place to kind of hang your hat. So I'd be excited for
Let me tell you, the highlight of that special coverage tomorrow, it's not going to be Tom Keene. It's going to be the vest that Michael McKee has been rocking all day.
All right.
Yes.
We'll see if the hat makes an appearance. Guys, that's going to do it for our cross-platform coverage on this Thursday afternoon. Don't worry. We'll be back tomorrow, same time, same place. This is Bloomberg.
And our coverage continues here on The Close. We're going to dive a little bit deeper into some of those earnings, wrap up that really, really long earnings season, and get some insights here as to where the markets may go next. Rich Weiss over at American Century. He joins us after the break right here on The Close, right here on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Romain Bostic. Let's take a look at where markets ended on the day. For most of the major indices, the end was, well, it was actually higher. The S&P 500 adding about 0.7% on the day. But we should point out a big chunk of those gains, in fact, all of those gains on a point basis, pretty much coming from Nvidia. To the downside, the biggest decliner in the S&P 500 today, and one to really keep an eye on, was Hormel. The shares dropped about 10%. This after the company cut its sales forecast. Of course, this is the maker of Spam, a lot of turkey products, having its worst day basically in a year, August 28th of 2025. And meanwhile, shares of Alphabet have been on an interesting downtrend as well. They only closed down on the day by about 0.4%, but it's now on a 3-day slump, and quite frankly, it's been down by several percentage points, going all the way back to the end of July. You flip up the board here, and we want to take a closer look at the tech space specifically. Nvidia had a great day, one of its best post-earnings day performances that we've seen in at least about 9 quarters, 8.7% gain on the day. But it kind of overshadowed what was also a phenomenal day for some of the software names. Salesforce rallying 23% on the day, CrowdStrike rallying 21% on the day, and Synopsys up about 14% on the day. And that actually brings us to our top story. That top story is about the resurgence of these software stocks over the past 2 months. The same software stocks that investors over the previous 12 months had given the Heisman stiff arm. The IGV software ETF, it includes Salesforce, ServiceNow, Adobe, a bunch of other names. It's up 17% since late June. The Philadelphia Semiconductor Index, it's sold off 14% since then. It's partly a shift away from the already locked-in monster gains from the picks and shovel names like Nvidia and Micron, and now a rethink of the beaten-down software names who are emerging from an earnings season that suggests rumors of their death may have been greatly exaggerated. That's giving some of the CEOs in the software space, well, a bit of an I told you so moment. Salesforce chief Mark Benioff kicked off yesterday's conference call by addressing the, quote, skeptics who said AI will lead consumers to abandon Salesforce or negotiate lower prices. Instead, he says, attrition is near record lows, contract terms are improving, and he says, quote, this nonsense of this SaaS apocalypse, I think it's time to stop. We shall see. We continue our coverage here with Rich Weiss, Senior Vice President and CIO of Multi-Asset Strategies over at American Century Investments. And Rich, you know, not to be glib about Mark Benioff and his prognostications here, but there have been a lot of people that have gotten this broader AI trade wrong. And I am curious that now that the earnings season is basically done, we've heard from Nvidia, the biggest company of them all, we've heard from Salesforce, Google, everyone in between here. How does it stack up? Based on what you learned this quarter, does it give you, I guess, a little bit more confidence in this bull run, or are you still a little skeptical?
No, definitely more confidence. The earnings are coming through. And Romain, as you well know, it's not just AI and tech, right? Year to date, it's pretty strong almost across the board. Risk on market in a number of different sectors of the stock market. Double-digit gains, top line and bottom line, virtually across the board year to date. So this just is a shot in the arm to lead us to believe it's going to continue. So I wouldn't say we're wildly bullish, but we're definitely leaning bullish.
Leaning bullish, is that lean specific to, I guess, the actual growth stories of these companies? And by that, I mean the actual supply and demand for their products, or is it more tied to more broader secular economic trends?
The latter. Broad-based. And in fact, if you look at the factors that are driving stocks this year, it's not growth, right? It's momentum and value of all things, which I think is lost, out there and by many investors. So broad-based. We are also, of course, keeping a good eye on non-U.S. equities as well. Emerging markets have doubled the return to U.S. And IFA this year so far. And also that's a great way to provide a hedge against the dollar decline, if there is one.
Well, I do want to just talk about that a little bit here, Rich. And we've obviously seen a partly, I guess, a catalyst because of some of the actions that Scott Bessent has made, or at least said he would make. This idea of the debasement trade, the idea that the fiscal situation and so many other factors out there, the fight or lack of thereof against inflation, is maybe making some investors a little bit skittish about risk assets, and for that matter, even non-risk assets, or like the Treasury bonds, which suddenly have a lot more risk seemingly priced into them.
Yeah, I think I'm in the majority here when I say I believe the recent actions by the Treasury Secretary to tamp down long-term rates is somewhat misguided. Stanley Druckenmiller's op-ed in the Wall Street Journal, well talked about, but treating the symptoms, not the illness, right? Let the bond market speak. We have a debt and deficit problem. And that's where the fire is, okay? So throwing some water over here on long-term rates, I think history's shown it's not a successful operation in the long run. In the short run, sure, it'll tamp down long rates, but we have a bigger problem to address. I believe the secretary knows that. He's doing what's needed in the short term, but we have a bigger issue to address right now.
Hold that thought for 1 second. In conversation with Rich Weiss over at American Century. We are getting earnings out of Gap. Interesting story here with the second quarter results showing a contraction in comp sales, down about 1%. The street was looking for growth of about 0.6%. The main drag, once again, continues to be Old Navy. Comp sales there down 4%. The street was estimating a drop in comp sales of 2%. And maybe, just maybe, that has a link to this next announcement. Gap now saying that it has appointed Michael Francis to take over as president and chief executive officer of the Old Navy brand. That will be effective on November 2nd. We should point out that Francis actually joined Gap earlier this year as the chief customer officer and head of marketing and shared services over at Old Navy. So the current head of Old Navy is out. A new one will come in on November 2nd, and we'll see maybe if they can work some magic there and maybe help boost that Old Navy brand. A contraction in those sales. We should point out Gap sales, Gap brand sales were up 10% in the quarter, beating estimates, and Banana Republic comp sales up 3% in the quarter, beating consensus estimates. I do want to go back to Rich Weiss over at American Century Investment and use that as a peg to get your kind of thoughts on the health of the consumer, because amidst all these tech earnings, we got earnings out of a lot of retail companies. We've got official economic data, and I don't know, Rich, it's kind of like a Rorschach test. You can sort of read through all this stuff and basically say the consumer's doing bad. You could also read through that stuff and say, hey, things are still pretty healthy.
It's bifurcated, right? I'm not the first one to talk about it, K-shaped recovery, right? Certainly the top wealth cohorts continue to do well. Large part of that is the wealth effect, heavy stock investors. The bottom leg of the K arguably not doing as well, most affected by what's effectively a regressive tax from the tariffs and other areas. So when you look at the aggregate figures, of course, the consumer overall looks very healthy. But if you look wealth cohort by cohort, it's not the case across the board. But overall, consumer relatively healthy, labor market hanging in there as well. And of course, as we just discussed, the AI boom, the manufacturing sector is really starting to waking up here. So I think the economy is on good track, at least in the next few months.
Final question, this really has to do about sort of picking and choosing where you want to allocate, specifically in the equity space. And we've had a lot of people on this program talk about this shift to quality or value, whatever term you want to put on it. What exactly does that mean? We started off the show with Stephanie Guild over at Robinhood, and she specifically talked about this idea, how she's laser focused on cash flow now. What constitutes quality and value right now in your mind?
Well, two different definitions here, distinct definitions. As our affiliates over at Avantis Investors heavily rely on a value factor, among other things. So it's defined, generally speaking, as a PE to growth type ratio or a valuation metric. It's obviously a lot more complicated than that. But putting sectors aside and size aside, value as a component is what are the earnings of the company relative to the price? It's as simple as that. There are a lot of complex measures to do it. That's where we're focused. That's where Avantis is focused on its stock picking technology, and they're having an exceptional year doing just that. So we're focused there. Quality, on the other hand, is not doing as well this year. It's really momentum and value that are driving the market in terms of stocks.
All right, Rich, got to leave it there. Great explanation. Rich Weiss, Senior Vice President, CIO of Multi-Asset Strategies at American Century Investments. As we continue our coverage here, taking a look at the post-market trade, shares of Autodesk in the red, shares of Workday in the red. We're going to unpack those earnings with Rishi Jaluria, Managing Director of Software Equity Research at RBC. We'll be back in a moment. This is Bloomberg. Let's take a look at Workday. The shares under pressure in the after-hours trade. Second quarter results relatively in line with estimates, though a subscription revenue forecast for 2027 that maybe came in just a touch lighter than what the street was looking for. Rishi Jaluria joins us right now. He's got a neutral on the stock, a 220 price target on a stock that, well, we should point out, had rallied more than 60% over the last couple of months heading into this print, though still down on a year-to-date basis. Rishi, what do you make of the results that we got today? And what does that tell you maybe about where the stock goes next?
Yeah, absolutely. And thanks so much for having me. Always a pleasure to be here. Look, I think you have to look at Workday's results as kind of totality, because if you recall, 2 weeks ago, we had a report that potentially Silver Lake Private Equity was interested in this, right? So that led to a little bit of a big pop. It's faded a little bit of it since then. So you had that, and you had the stock trade up a little bit today off Salesforce earnings. But look, I would characterize these results as better than feared. Workday's a name that I think investors have worried about a lot with, the AI fears, what happens to headcount for a company that's primarily driven by seat-based model. And especially with Anil, the co-founder and now CEO and former CEO, stepping back in, I think that led to a little bit of concern. Look, I think results, the numbers were in line with what we expected. Definitely looking forward to the call in a little bit, in about 35 minutes, and seeing just what they talk about their own AI strategy and early kind of green shoots there.
Well, I do want to ask you about the Silver Lake. And in fairness, I mean, the stock had kind of run up even before that became public, or at least the rumors really became public. But I mean, most investors looked at that as, well, if Silver Lake sees something in here, and this reporting at the time by Bloomberg was that these talks have been going on for a while. So this wasn't just something that popped into their head. What does that tell you about the sell-off that we saw in Workday and some of these other SaaS stocks? I mean, does a company specifically like Workday, and for that matter, what we heard from Benioff last night on the conference call, I mean, they're basically saying, look, we have a moat here. We're entrenched, and that's not something that AI is just going to shake loose overnight.
Yeah, look, I think that's exactly right. I think we all looked at that as a sign that, private equity sees what's going on, sees the pullback that's happening in application software, sees that it's overdone. And I think that there's a lot more certainty around what the future shape of software looks like. Obviously, there's concerns around pricing, around seat-based models. But I think the peak fears of DIY, that companies are just going to vibe code their own versions of Salesforce or Workday, those are kind of in the rearview mirror. Then I think what happens here is with Workday, and maybe why they're engaged in discussions, don't forget there's a dual class share structure here. So Anil and David Duffield still control the voting here. It's maybe a little bit of a potential MBO if it were to happen, where they can kind of accelerate the AI roadmap rather than your kind of traditional private equity playbook of let's go raise margins and gut investment.
So, well, yeah, and that's a good point. But Anil, though, too, I remember earlier this year, I mean, he was very blunt about it. And I was really struck by Benioff's comments yesterday. But I mean, Anil said something to the effect, there's no amount of vibe coding that's going to basically replace, a lot of this enterprise resource planning software. You buy that?
I do, 100%. In fact, we put out a giant piece on this, actually putting framework and numbers behind the whole DIY story. And look, the punchline of all of this is ultimately when you factor in the entire total cost of ownership, you think about the cost to maintain and replatform, you think about security risk, you think about like the lack of, what happens when you have a worse product, it all plays itself out. And when if a company vibe codes their own and sees a security breach, it's going to okay.
Rishi, always a pleasure. We'll let you get to that conference call. Rishi Jaluria over at RBC Capital. We'll be back in a moment with a closer look at the world of real estate. All right, many real estate investors gravitate to the four food groups of the industry's focus: residential real estate, offices in large cities, data centers, etc. Bain Capital, though, is choosing a different path, aiming to invest around future real estate trends through areas like open-air retail, leisure and hospitality, rentable townhomes, marinas, digital real estate. Ryan Cotton, well, he heads all that as the head of real estate over at Bain Capital. Ryan, great to have you here.
Thanks for having me, Ron.
I mean, you talk about this idea that we are in this commercial real estate cycle, 55-month-long cycle.
And counting.
And counting. But what does that cycle mean? Is this like a valuation cycle, a leasing cycle, a demand? What is it?
Almost all of the above. We kind of created the perfect storm through COVID, where you had zero interest rates that stimulated a whole bunch of development, a lot of supply growth into the markets, followed by the rate shock that came afterwards, which reset the price and yield of that real estate. And so you found yourself in this perfect storm of lots of available supply and therefore not a lot of growth in rents and NOI, at the same time that you had a reset in the cap rate environment to a higher pricing paradigm.
Well, but I've heard other people say that on this show, but then they also say they went back into multifamily homes. They went back into offices. They went back into those traditional areas that were beaten down. And it seems like there's value there. I know you've not been very bullish, or at least not willing to put a lot of money into the office space, but why shun those areas?
Yeah, well, I think that's a bit of a reflexive reaction born of history that, buy the dip is conventional wisdom in real estate. And for the last 20 years, where you had a declining interest rate environment as a benign backdrop, that strategy worked fairly well. I think the problem is twofold. Now we're in a world where you're in the higher for longer interest rate world. You can't rely on the rate reversion trade to make your commodity multifamily asset more valuable. You really have to grow NOI. You have to deliver growth. And at the same time, we've got oversupply in the industry that's weighing against that in the office sector and places like that. And so picking your spots where you can find growth and where you can build NOI is I think, the secret to investing through this cycle.
Well, let's talk about some of those areas that you picked, because I was going through the portfolio. I mean, this reads like a country club membership. It's like golf clubs, marinas, open-air retail, but anchored by an Equinox or Trader Joe's, the fancy stuff. I mean, what is that a bet on? Is that just a bet on an affluent consumer? Is this kind of like the recession-proof model? What are you looking for here?
Yeah, I think everything we do is thematic in its origin, right? There has to be a long-term demand driver that sits behind it, something that's changing in the way we live, work, play, shop, that's causing us to need that real estate more than we have in the past. Some of those thematics may be the K-shaped economy, the wealth of America growing, and as people get wealthy, they consume different things. They buy private airplanes, they buy golf memberships, they buy luxury boats, and that leads to private airplane hangars and golf courses and marinas being stimulated demand situations that will lead to better NOI growth.
I am very intrigued by open-air retail, because I thought that was left for dead a long time ago. So explain to me, is that not just a buy the dip? You see a real longer-term structural opportunity there?
Absolutely.
Why?
Two things
What's changed?
One, it has the best fundamentals of any sector in real estate. 97% occupancy, almost no supply growth, and an incredibly healthy tenancy that sits underneath it. You can't find that in office, you can't find that in multifamily, and so just the quality of income you're buying is incredibly high. The second thing, though, is we've been through a re-tenanting of those real estate assets. In the past, they were bad assets because they had a tax preparer and a dress shop and a stationery store, where if you raise their rent, your tenant would go out of business. But now we've turned over to a next generation of retailing where you have site-based services like laser skincare spas and healthcare and daycare, where you have Lululemon and Apple stores, and just a much better tenancy that's drawing traffic and creating sticky revenue.
But on that point, though, I mean, how much obviously, I assume a big part of this model is that those rents go up over time. But at some point, how much can you extract out of those names? I would assume you have to have faith that they can grow, those businesses can grow in order to be able to afford that. Otherwise, you face the same situation those tax preparers and other people you see.
For sure. And so I think as you select assets in that, understanding your tenancy, the business model of those tenants and their growth strategies is really important. You want a healthy inline tenancy that's going to grow with you and tolerate rate bumps along the way.
In the commercial space, I am curious about this refinancing wall, which I thought was supposed to come in 2024, then 2025.
Yes.
We're pretty much
next year.
Almost through 2026. Is that just a thing of the past, or is this just kind of we're just kicking the can down the road, hiding the pain is being swept under the rug somewhere?
Yeah, I think we've been kicking the can a little bit. Some of the lessons of the GFC, blend, extend, pretend, got played out through this cycle as real estate hit distress and people just kept kicking maturities. One of the challenges, though, is that duration has been shortening. 10 years ago, it was a 10-year loan you'd get. 5 years ago, it was a 5-year loan. Today, you can get a 2-year extension. And so we've been piling up these maturities on top of each other. And 27 to 30 is really the bolus of maturities maturities that hit this industry. And there's going to have to be some real working through of all that debt overhang.
So give me a sense of what your house view is on interest rates, because obviously there's been a lot of talk, particularly about long end rates going up because of fiscal pressures and other things here. What are you factoring in right now when you're sort of looking at either what's existing in your portfolio or new deals that you're looking at?
For sure. I think for a very long time, call it 5 years, we've had a paradigm at Bain Capital of high for longer, that rates were going to be elevated and stay elevated for a long time, born of inflationary pressures in the economy. Energy prices now, but before that, onshoring, reshoring, deglobalization, a whole bunch of things, stimulative policies like the Big Beautiful Bill that drive liquidity in the economy, all inflationary, all create a rate backdrop for higher for longer interest rates. And of course, now we've got the Fed being tested a little bit, that's putting pressure on the long end of the curve. And so what we've been doing is really underwriting with a lens toward, rates are going to stay elevated, and you have to be able to drive growth in that environment.
So your most recent fund, or that fund 3 then, give me a sense here, because you were targeting like mid to high teens returns on that. How does sort of, a 5+ percentage points on a Treasury bond affect that math?
Yeah, it was tough if you owned real estate. It's great for buying real estate. Now that the basis is reset, you can buy in at a cap rate that's repriced relative to that Treasury. You're buying in at the 40th percentile of long-term valuation for commercial real estate.
But like what cap rate what exit cap rate are you underwriting?
It depends sector by sector. I'd say industry average exit caps these days are sort of in the 6s, something like that. Gotcha. And so you get bond-like yields with growth and convexity.
And so are your assumptions that cap rates will fall over time?
No. Our assumption is they're going to hang roughly where they are, bounce around a little bit, but roughly stay the same.
I do have to ask you about the digital side of this and AI data centers, because that seems to be where the gold rush, or at least the perceived gold rush, is. How deep are you in that?
We have some exposure in Asia. We own the 2nd largest data center platform. In Europe, we have the 5th largest data center platform. We don't do a ton here in the U.S.
What about on the power side?
We do own a bunch of powered land here in the U.S., and so have aggregated power commitments that we can sell back to the developers.
Is there a reason why you stayed away from that, or is it just not your focus?
I think the question is, what's your competitive edge in that strategy? And for everything we do, we want to be competitively advantaged and feel like we're the right people to do it. And in digital and data centers, there are some incredibly skilled operators and platforms in the United States that are tough to compete with.
I just have 2 quick ones here. One, I was curious about your senior housing portfolio. Every real estate person is trying to push into senior housing and whatever they call it, longevity and living. Why would you shed that?
Why are we selling it?
Yeah.
Because the pricing environment is incredible right now, because all of that capital is running into the force. You're selling assets at 130 to 140% of replacement cost and 150 basis points inside the cap rate that they traded at a year ago.
Yeah, and just a little earlier, we had the Agilent CEO on, and I am curious about your exposure in life sciences. It was hard to see any sort of material investment in that. Is that purposeful?
We have slowed that down considerably. We have a back book that's doing quite well. I think that sector is probably 2 to 3 years away in the recovery cycle. You are creating demand, you are seeing growth, the fundamentals are really good. There's just a large supply overhang that needs to be burnt off before you're going to get healthy there again.
All right, Ryan, great to have you here. Got to get you back for a longer conversation. Ryan Cotton, he's a partner over at Bain Capital and head of real estate. When we come back, our sit down with billionaire attorney John Morgan of Morgan & Morgan. We're going to talk about how he built America's largest personal injury law firm and, well, his plans on what he wants to do next with regards to maybe selling a stake in it. That conversation coming up next right here on Bloomberg. All right, about 40 years ago, John Morgan and his partners started a law firm and began to build it up. About 20 years ago, he bought out those partners and really began to expand that business. It's called Morgan & Morgan, and it is now a multi-billion-dollar empire spanning all 50 states. He's also released a book about his life called Life is Luck. I had a chance to catch up with him. I asked him specifically about what comes next for his law firm and about the possibility of maybe taking a portion of that firm public. Let's take a listen.
I do know this. Very successful people do not like the title of my book, Life is Luck.
Yeah.
Because very successful people want to say, I did it on my own. But when you really think about what happened, there is so much luck involved. There's 8.5 billion people in the world, but you were born in the United States. That's your first lucky day. Being born is trillions to one. Then you're born in the United States. And then. And when you really go back and look at it, there is a lot of luck that happened. Now, there's 3 types of luck, which I call in the book. pure luck, plan luck, and practice luck. So there are ways to increase and improve your luck, and that's what the book is about.
It is about, and we should point out, most of our viewers, they make their money charging fees to other people for their skill level, and they would probably bristle at the idea that their success is all luck. But your point is taken, and I kind of want to link that to Wall Street, because you've grown this firm to a behemoth, a couple $2 billion in revenue. A few months ago, Bloomberg Law reported that you were in talks with JP Morgan and other folks on Wall Street about raising money for a minority stake in the business and maybe potentially even an IPO. Can you give us an update on where those talks stand, assuming they're still happening?
If we were having this conversation at 5 o'clock this afternoon, I'd be better equipped to tell you, because when I leave here, I'm going down the street to JP Morgan to hear what they're thinking and what they're talking about. So I'm going to have my very first sit down after they've taken my numbers to market. But look, we're in an age right now where, private equity is always looking for everything, whether it's air conditioning or plumbing and dentistry. And all of a sudden, legal is a category that has great margins that they're very interested in.
Well, even more so now. I mean, you mentioned some of those industries. Almost none of them are sort of in that AI tech-related zeitgeist that I think a lot of these P guys are kind of a little bit afraid of. They're looking for the AI-proof businesses. I assume law and obviously the fees you collect from those practices falls into that category?
To a degree. And look, we hired a very high-ranking AI guy from Amazon. We all have to figure AI out. If you're an older guy, it's hard to figure out things like AI. But yeah, that's a area. But for us, our real strength of Morgan & Morgan is our brand, the number of cases we bring in a year, but our real strength is our verdicts and results. Because this is a business you can't bluff. You can't say, let's go out to the OK Corral and have a gunfight unless you're wide open.
What are they actually buying into here? Is it the actual law firm? Is it the brand?
Well, you can't buy law firms.
Well, I understand that, and we'll get to that. I understand that. But I mean, the idea of sort of what the law practice is, and obviously a bite at those contingency fees. Is this about the technology that's wrapped around this? Is it just about the personal branding of John Morgan and Morgan & Morgan?
It's about this. Yeah. Look, we're the only firm in America that's in all 50 states. And that's hard. Our ad budget for next year is $700 million.
That's a lot.
That's a lot. And it is private,
Is that what you need to keep a business like this going? You have to spend that?
Well, yeah, because now what's happened, there's a lot of Wall Street money in here competing against me now. So, yeah, we have to do that, and we spend our big office that monitors all this is out in Brooklyn. But yeah, that's to keep the cases flowing the way we want. That's to keep increasing. But here's the thing: we have a lot of states that we're not in. We're the ramp for growth here is gigantic.
Yeah.
Because there's cities in America that we're not in yet.
How much does it cost to sort of, get a new client? I mean, that's a lot of money. That's basically almost like a quarter of your revenue, more or less, right? Or maybe even a little more than that.
Yeah.
Yeah. So, I mean, that's a lot.
Well, that's a quarter of, yes. Yeah. It is.
But is there a way to get that cost down, or does that not matter to you?
It doesn't matter. Yeah. The business is broken into two halves. Core, which is the South United States, which is very profitable, immensely profitable. And that's where really the $2.5 billion in revenue comes from. Expansion is what we're just getting into. And when you go into a new city like New York City, you spend a lot of money just to ramp up. You don't start breaking even for 3 years, because you got the cost of advertising, you got your people, the delay in getting it takes about 3 years to cross the Rubicon. So in my expansion, I'm probably in it for like $140 million. Some of them are starting to turn. Some of them, Philadelphia was profitable last year. New York is going to be profitable this year. But it's a long, slow slog until you get there.
And that has to be, I would think, top of mind, because as you know, I mean, if you do, whether you sell to a private equity firm, stake in a private equity firm, or to the public, I mean, the demands of Wall Street are obviously to compress those costs and to provide some sort of reliability. of what that profitability be will going forward. You've had the luxury of not having to deal with Wall Street for all these years.
And listen, one thing we know, I don't know if I'm going to offend people on Bloomberg when I say this, not Bloomberg itself, but what we know is a lot of times when private equity comes in, quality goes down. Now, what we believe that's our advantage is when these PE people come in, they can't keep spending as much as they did on advertising because they got to service debt. They may have to, they're not going to have the founder there. When Warren Buffett buys businesses, he keeps the founder there. So the founders are not necessarily in these roll-ups. So we also see that as an advantage to us, PE coming in, letting a couple of years shake out, let these firms implode. On their own because of the PE firms running them.
You alluded to this idea that technically you can't really take a law firm public. There are no publicly traded law firms here because the rules are basically that the partners, or more or less, have to be the ones that actually own the practice. But we've seen these MSO structures start to become a little bit more popular. I'm not sure I've seen one tested on the public market here in the U.S., but we have seen it overseas. Is that kind of the future, do you think? Is that aperture opening where we are going to see, if not from Morgan & Morgan, maybe another law firm go public with an MSO type of structure?
If you call it going public, I don't know if it's actually going public, but yeah, MSO, what MSO does is you sell a piece of your business to the MSO, and that MSO has things like, likeness, call centers, a lot of things like that. So you take a hunk of your pie and you move it over here, and then you pay the MSO for your call center for the things that are not legal. So it's all new, but I will tell you this, and the thing I worry about, and we all should worry about it, is right now, hundreds of law firms are exploring this. There's a gold rush. The one thing, I didn't take science and math in college because I wasn't good in science and math, but I did study history and political science. And one thing we know about the gold rush in the 1800s is most of the gold was fool's gold. And so what I got to be really worried about in this gold rush right now is that I'm actually looking for gold but not ending up with fool's gold. So I'm very circumspect about what I'm doing. I don't have to do anything. The lucky thing for us is flat and normal is great. Look, one day, probably not in my lifetime, but one day, non-lawyers will be able to own. And look, if that ever happened, what the value to my firm is astronomical. If you use Wall Street PEs, my firm could be worth $20 to $22 billion if you use Wall Street PEs. Well, people that are selling their firms now, they're getting, a 3, 4, maybe a 5x to sell out. But if you're able to wait for the long run, which my children will, and non-lawyers can own the firm and you can go public, it's a huge, huge number using Wall Street's metrics.
Using their Wall Street, without those metrics, I mean, what do you think your firm is worth now?
Well, at least 10 billion.
10 billion. That's huge for a law firm. Fees.
10 billion is what I would take. That's what I would, that would be, yeah.
Is what you've
Because
built.
See, the other thing that we've done, I've got the core, which is very strong. But what is still to be determined is really America. I haven't tapped hard into New York yet. Chicago, just went into Los Angeles, all of California, Philadelphia. Those numbers have not turned yet. But I've been there for so long, 3, 4, 5 years, that I know it's going to be good because I got the cases.
Part of my conversation with a billionaire lawyer, John Morgan, of course, the founder of Morgan & Morgan, now seeking to, I guess, figure out what the next phase is for that company. You can catch that full interview online on Bloomberg.com/videos. Meanwhile, some breaking news, this involving Citadel. this involving its second quarter performance and, no surprise, a huge trading haul in that period. $7.3 billion of trading revenue for the second quarter. That's more than triple what it had from the same period a year ago. That red headline just now crossing the wire. You can read that story on the Bloomberg terminal. We'll be back in a moment. Let's set you up for what to watch over the next 24 hours, and it all revolves around Kevin Warsh's speech at the Kansas City Fed's Economic Symposium in Jackson Hole, Wyoming. That speech will kick off at 10 a.m. Eastern Time. Now, there will be a special surveillance special starting at 9 a.m. Eastern with Tom Keene and Lisa Abramowitz. They're going to have interviews with former Kansas City Fed President Esther George, current Cleveland Fed President Beth Hammack, BOE Governor Andrew Bailey, former Fed Governor Richard Clarida, and quite a other folks there. Tune in for that at 9 a.m. We will have full coverage of the speech live at 10 a.m. and, of course, reaction after to anything that Kevin Warsh says that could potentially move the market. We'll be back on The Close tomorrow, right here on Bloomberg.